So every year, right, the major investment banks on Wall Street, they spend, literally billions of dollars hiring the smartest, most ambitious MBA graduates in the world.
Oh, absolutely. They put them in these massive skyscrapers,
Yeah.
hand them these incredibly complex financial models.
Yeah, and they basically task them with one singular goal, just beat the stock market.
Right. Find the hidden value, crunch the numbers better or faster than the next person.
Exactly. But what if a mathematical theory developed way back in 1970 mathematically proves that every single one of those brilliant analysts is essentially wasting their time?
I mean, it is the ultimate existential question for anyone entering the field of finance.
It really is.
Because if the market perfectly prices in all available information instantly, well, then trying to outsmart it is, it's essentially a fool's errand.
Right, you are playing a game that has already been won by this giant collective hive mind. And look, if you are an MBA student listening to this right now and you're gearing up for your portfolio management exam, that specific tension between wanting to beat the market and having to accept its undeniable power, that is exactly what you need to master.
It's the core of the whole curriculum.
It is. So today, we are taking your source material, specifically those dense notes labeled Chapter 13 that cover the theories of portfolio management, and we are doing a complete deep dive. We're going to extract the absolute core of how this financial engine actually works.
Yeah, we want to move past the alphabet soup of acronyms here.
Right, so you can walk into that exam room not just with, memorized formulas, but with a deep intuitive understanding of the actual mechanics.
Because, honestly, the unifying theme across all these notes, the golden thread that connects every single theory we are going to dissect today, is the relentless pursuit of maximizing returns for a given level of risk.
And we have to be clear about risk.
Right, because in the academic finance world, risk isn't just some abstract, scary feeling. It is measured mathematically as variance.
Right.
Everything we unpack today is fundamentally about how the market supercomputer processes information to price that variance.
Okay, so before we can even touch the famous mathematical model,
What it actually means for a market to be, efficient.
exactly. And the source text does something really brilliant here. Instead of just throwing a sterile definition at us, it points us to an era when a major market was catastrophically inefficient.
Oh, the Indian stock market example.
Yes. Let's talk about the Indian stock market prior to the reforms of 1995 and 1996, because it was not the sleek, digitized, algorithmic ecosystem we see today.
Far from it. I mean, it was an environment characterized by systemic vulnerabilities, physical paperwork, and just a staggering lack of transparency.
Physical paperwork. Just imagine that for a second.
Right. The notes specifically highlight the Harshad Mehta scam of the early 1990s as the ultimate catalyst for change there.
Yeah, we have to talk about that.
At that time, the Bombay Stock Exchange operated with physical share certificates, people literally handing paper to each other.
Which means settlement cycles could take weeks, right?
Weeks. And crucially, the market completely lacked modern circuit breakers.
Okay, let's pause on circuit breakers for a second because understanding their absence really explains the chaos for the exam.
It does.
In a modern market, if a stock plunges or spikes by, say, 10 or 15% in a matter of minutes, the exchange's computer systems automatically halt trading on that asset.
It literally cuts the power.
Right. It gives human beings a moment to step back, read the news, and figure out if the massive price movement is based on reality or just, a cascading panic.
But pre-1995 in India, you didn't have that pause button.
You had free fall.
You had sharp, completely unfiltered declines in script prices. It was a purely emotional, momentum-driven environment.
Where a panic could wipe out massive amounts of wealth in hours.
Exactly. And the Harshad Mehta situation exploited these exact inefficiencies. He utilized fake bank receipts to pump immense amounts of liquidity into the stock market.
Which drove prices up to astronomical, completely artificial levels.
Right. And when the music finally stopped and the lack of underlying funds was revealed, the crash was just devastating.
But it's that exact devastation that forces evolution, doesn't it?
It always does.
According to the text, the resulting modernization effectively birthed the efficient market we recognize there today. We saw the introduction of the automated online trading system.
Which killed the physical paper trails entirely.
Right. And then we saw the depository system dematerializing shares into digital formats.
They also introduced strict insider trading regulations, corporatized the stock exchanges, and launched derivatives markets.
And they banned something called bad law, which the text points out, was a deeply controversial carry-forward system.
Yeah, bad luck was wild.
Right. For the students listening, Badla basically allowed buyers to purchase shares without actually taking delivery or paying the full amount.
You were essentially rolling the transaction over to the next settlement period while paying an interest charge.
It fueled rampant, completely unbacked speculation. So by banning Badla and instituting rolling settlements, the regulators forced trades to actually settle.
They forced reality back into the pricing mechanism.
And that concept, forcing reality into the pricing mechanism, that brings us to the textbook definition of market efficiency.
Which is going to be on the test.
Oh, guaranteed.
Yeah.
So how do the notes define an efficient market?
It is a state where share prices follow an independent path. They are dictated entirely by the current, immediate dynamics of demand and supply, completely uninfluenced by previous prices.
Okay, that phrase, independent of previous prices, underline that if you're taking notes. It is massive for the MBA exam.
It's the whole ball game.
It means that what a stock did yesterday or last week or last year has absolutely zero bearing on what it will do today. The market has no memory.
Because in a truly efficient market, the current price of a security is an ongoing real-time estimate of a company's intrinsic value.
It reflects the fundamental worth of the business, right?
Its assets, its actual cash flows, its future prospects, based on absolutely everything known up to this very second.
But to make this happen, to reach this theoretical state of perfect efficiency, the text outlines 3 essential conditions, 3 pillars.
And for anyone studying this material, if you get an essay question on market efficiency, these 3 pillars are your structural outline. Just write them down.
Okay, let's hit them. Pillar number 1.
The first pillar is the assumption of the rational investor.
Okay.
This posits that when new information flows into the ecosystem, say a surprise earnings report, a change in federal interest rates, a CEO stepping down, investors adjust their valuation of the company logically and rationally.
They calculate the new intrinsic value.
Exactly. And the stock price immediately moves to reflect that mathematical reality.
Okay, look, I have to play devil's advocate here. Assuming investors are universally rational is a huge leap.
Oh, a massive leap.
We watch the market every day. We see meme stocks explode by 500% because someone posted a rocket ship emoji on a message board.
True.
We see panic selling when a totally unrelated macro event spooks retail traders. Human beings are deeply emotional creatures. What happens to this pillar when fear and greed take over?
Well, that behavioral reality leads us directly to the second pillar of the theory, independent deviations.
Okay, explain that.
The academic framework actually concedes your point. It acknowledges that, yes, individual investors will act irrationally.
Right.
You will have pockets of extreme, unjustified optimism, and you will have waves of extreme, unwarranted pessimism. But the theory hinges on the word independent.
Meaning the irrationality is random and uncorrelated?
Precisely. The core argument is that the extreme optimism of one group of irrational traders is statistically likely to be canceled out by the extreme pessimism of a completely different group of irrational traders.
So if 1 million people are throwing darts blindly, the errors are random.
Exactly. They average out to 0. The noise cancels itself out, leaving the underlying price as a relatively true reflection of intrinsic value.
It's an elegant statistical defense, but let's push it one step further. What if the irrationality isn't random?
What do you mean?
Well, what if there's a herd mentality? What if all the irrational investors decide to be overly optimistic at the exact same time, driving a stock price massively above its actual fundamental worth?
So the noise isn't canceling out, it's compounding.
Exactly. What happens then?
And that, right there, is why the third pillar is the most crucial part of the entire mechanism, effective arbitrage.
Effective arbitrage.
This is the market's immune system. When a herd of irrational investors temporarily breaks the pricing mechanism and drives an asset way above or below its true value, the professionals step in.
Ah, the smart money.
The smart money, the hedge funds, the algorithmic traders, the institutional giants, they are constantly monitoring for these exact dislocations.
Because they smell blood in the water?
Exactly. They see a stock that is mathematically worth $50, trading at $80 purely because of retail hype.
So what do?
They immediately step in and aggressively short sell that stock. Their immense, heavily capitalized trading volume completely overwhelms the irrational retail buyers.
They crush the mispricing.
They force the security back down to its objective fair value, and they pocket the difference as a riskless profit.
It's like a giant high-stakes sports betting market.
How so?
Well, let's say a star quarterback tweaks his ankle in practice. Before the news even hits the mainstream media, the sharp bettors, the smart money, they get wind of it.
Right.
They instantly bet massive amounts of money against that team. The sportsbook is forced to adjust the point spread instantaneously to balance the risk.
Okay, I see where you're going.
By the time the casual fan hears about the ankle injury and tries to place a bet, the odds have already shifted. The new reality is already perfectly priced in.
That is an excellent way to visualize the mechanism of efficiency. The arbitrageurs act as the house, constantly moving the line to reflect the mathematical truth.
Makes sense.
However, the text does set a vital boundary for this theoretical model to function perfectly. It states that efficiency depends on the free flow of ideas and information and relies on the perfect knowledge of investors.
And perfect knowledge is where these academic models often lose people, isn't it?
Oh, totally.
Because we know for a fact that an individual retail investor trading on their phone on a subway commute does not have the exact same information or processing power as a multi-billion-dollar hedge fund with servers co-located next to the stock exchange.
It's true. But from an exam perspective, you must understand what perfect knowledge implies in the aggregate.
Right, for the test.
It doesn't mean every single human knows everything. It means the market as a collector entity absorbs and reflects all available data.
Because there are millions of participants.
Yes. No single investor has enough localized power to indefinitely dictate the price against the consensus of the data. Price changes happen only when genuinely new, unforeseen information enters the ecosystem.
Causing a sudden disequilibrium in demand and supply.
Exactly.
So if the market is this incredibly efficient, information-devouring supercomputer, we need a way to measure its power.
We do.
We need to categorize just how good it actually is at pricing things in. And that brings us to the godfather of modern financial theory, Eugene Fama.
Eugene Fama. He published his seminal work in 1970, and it is the bedrock of Chapter 13.
He formalized the efficient market hypothesis, or EMH.
Right. But before he broke it down into its famous 3 tiers, he established a foundational concept known as the fair game model,
Okay.
which is heavily tied to the random walk hypothesis.
The random walk. I always picture the old statistical metaphor of a pollen grain suspended in water being knocked around randomly by water molecules.
That's a great visual.
You know it's moving, but you can't predict the exact trajectory of its next movement based on how it just moved.
That's Brownian motion, and it maps perfectly to Fama's random walk hypothesis for stock prices. The rule establishes that current prices fully and completely reflect all currently available information.
Everything we know right now is already baked into the price you see on the ticker.
Exactly. Therefore, the expected risk and the expected return are in perfect, fair game alignment.
So if everything known is already priced in, what makes the price move tomorrow?
Only the arrival of the unknown.
The unknown.
Brand new, unpredictable information. And because new information is, by definition, unpredictable and random, the resulting price shifts will also be unpredictable and random.
Tomorrow's price is a random walk from today's price.
Precisely.
Which means looking at a chart of yesterday's prices to predict tomorrow's prices is like trying to predict the outcome of a coin flip by staring at the last 10 coin flips.
The coin doesn't remember.
Exactly, the coin doesn't remember. Now, Fama took this random walk concept and built the efficient market hypothesis into 3 distinct forms.
And if you are studying for this exam, you need to know the definitions, the implications, and the differences between these 3 tiers inside and out.
So let's tackle the first one.
Tier 1 is the weak form efficient market hypothesis.
The weak form.
The weak form asserts a very specific boundary. Subsequent prices are entirely independent of previous prices. The current stock price fully reflects all historical market data.
Define historical market data in this context. What exactly are we talking about?
It includes the sequence of past prices, the historical rates of return, and the past trading volume. Anything that happened on the exchange prior to this exact second.
Okay.
The exam implication here is absolute. In a weak form efficient market, technical analysis is completely useless.
Okay, I want to make sure we underline this because an entire sub-industry of finance is built on technical analysis.
A massive industry.
This is the practice of pulling up complex charts, looking at moving averages, drawing resistance lines, and looking for shapes, head and shoulders patterns, cup and handle formations.
Right, the chartists.
Technical analysts believe that human psychology repeats itself, and those repeating psychological cycles leave visual footprints in the price charts.
And Eugene Fama's weak form hypothesis looks directly at those analysts and says they're looking at illusions.
Illusions.
If the market is weak form efficient, the past is already fully absorbed into today's price. If a head and shoulders pattern historically meant a stock was about to drop, the smart money would have already seen the pattern forming.
And they'd short the stock.
Right, driving the price down before the pattern even completed. The arbitrage mechanism destroys the predictive power of the chart. Studying past trends gives you absolutely zero edge.
Okay, so if the weak form destroys the chartists, what does Tier 2 do?
Tier 2 is the semi-strong form. This expands the perimeter of what the market supercomputer has already absorbed.
Okay, how far?
The semi-strong form asserts that security prices reflect not just past market data, but all publicly available information.
So we are moving beyond just looking at the ticker tape. Public information means macroeconomic data like the national unemployment rate or the consumer price index.
Exactly.
It means industry-wide statistics. And crucially, it means corporate disclosures. Annual reports, balance sheets, announcements of stock splits, dividend declarations, changes in executive management.
Everything that a company legally releases to the public.
And the takeaway here for the MBA student is a heavy one, right?
It is. In a semi-strong market, fundamental analysis is of no benefit.
And this brings us back to that massive contradiction we opened the show with. Fundamental analysis is the absolute bedrock of modern value investing.
It's what Warren Buffett does.
Exactly. It is why investment banks hire thousands of analysts to scour through hundreds of pages of a company's 10K filings, projecting future cash flows and calculating debt-to-equity ratios.
Right. They are trying to find companies whose intrinsic value is higher than their current trading price.
So if the market is semi-strong efficient, are you telling me that reading the annual report is a waste of time?
Under the strict academic definition of the semi-strong form, yes, because it assumes that the millisecond a company hits publish on its quarterly earnings report, algorithms and massive institutional computers scrape that data, process the implications, and execute trades instantly.
Instantaneously.
The market price adjusts to the new fundamental reality before a human analyst can even read the first paragraph.
Right.
By the time you finish your discounted cash flow model on your spreadsheet 3 hours later, the opportunity for arbitrage is long gone. The current price already reflects the very conclusions you just came to.
So the only way an analyst actually makes money is by being the absolute first to process it, or by finding a flaw in the market's processing.
Precisely. They're fighting over milliseconds and microscopic inefficiencies. They're hunting in the tiny margins where the semi-strong efficiency momentarily stumbles.
But as a broad rule, public data yields no consistent alpha.
No consistent alpha.
All right, so weak form invalidates technical analysis. Semi-strong invalidates fundamental analysis. What is left? What is Tier 3?
Tier 3 is the theoretical extreme, the strong form.
The strong form.
This asserts that security prices reflect absolutely all information. Not just past data, not just public disclosures, but perfectly guarded private information. Insider information.
Wait, let's play this out. Let's say I am the CEO of a massive pharmaceutical company.
Okay.
I am sitting in a locked room with my lead scientist, and they tell me our flagship experimental drug just failed its final clinical trial. The news won't be made public for 3 days. Are you saying the strong form hypothesis believes the stock price will somehow already reflect that failure before I even leave the room?
The theory argues that in a perfectly strong form market, yes.
That's wild.
It posits that no individual, not even a corporate insider with monopolistic access to top-secret realities, can consistently earn greater risk-adjusted returns.
How is that even possible?
It assumes that through back-channel leads, the actions of affiliated suppliers, the subtle shifts in corporate behavior, or the aggressive probing of investigative analysts, the private reality bleeds into the public price action almost immediately.
It sounds almost supernatural. The market operates like an omniscient being.
It is the most radical of the three forms. And as we will see when we transition to the data, it is the form that struggles the most when subjected to the harsh light of reality.
Which is the perfect pivot. Because in the world of academic finance, you can't just publish a hypothesis about omniscient markets and expect everyone to accept it. You have to prove it mathematically.
You need empirical evidence.
Right. And for the student listening, this is where the exam gets granular. We are moving from the philosophical definitions into the empirical evidence.
How do researchers actually test if a market is weak, semi-strong, or strong?
Exactly. Let's take them in order. How do we test the weak form? How do you mathematically prove that yesterday's price doesn't predict tomorrow's?
The source material details several exhaustive statistical methodologies. The first major test used to validate the weak form is the serial correlation test.
Correlation. So that's all about how two variables move in relation to each other.
Right.
So we are testing if the price change in period 1 relates to the price change in period 2.
Exactly. Researchers like Moore and Fama himself ran massive data sets using this method. Fama specifically analyzed the daily price changes of the massive companies making up the Dow Jones Industrial Average over extended periods.
Okay, what was he looking for?
He wanted to see if a positive return on Monday increased the mathematical probability of a positive return on Tuesday.
And if technical analysis works, there should be a strong correlation. A trend should mathematically persist. What did the data show?
The data showed an incredibly low correlation coefficient.
Really low.
The relationship was statistically insignificant. A price rise yesterday provided absolutely no reliable predictive power for a price rise today. The sequence of percentage changes behaved like a sequence of random numbers.
Okay, so testing the exact percentage changes proves randomness. But what if we simplify it?
Simplify it how?
What if we don't care if the stock went up 5% or 1%? We just care that it went up. Technical analysts love a winning streak.
That exact logic led to the second methodology, the run test.
The run test.
This is an incredibly elegant statistical tool because it completely ignores the absolute size or magnitude of the price change. It strips the data down to pure direction.
So an increase in price is just recorded as a plus sign. A decrease is a minus sign. A flat day is a 0.
Correct. And a run is defined as an uninterrupted sequence of price changes in the exact same direction.
Okay, give me an example.
So if a stock goes up on Monday, Tuesday, and Wednesday, then drops on Thursday and Friday, you have a sequence of plus, 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 minus, minus.
Got it.
That sequence contains 2 runs, one positive run of 3 and one negative run of 2.
I see the logic here. If a market is inefficient and prone to long, predictable trends, you would see incredibly long runs of pluses or long runs of minuses that defy normal probability.
Exactly.
But how do you prove it mathematically? What are you comparing the stock's runs against?
You hold the real-world stock data up against a mirror of pure engineered mathematical randomness. Statisticians generate a completely random series of pluses and minuses. Imagine flipping a coin 1,000 times and recording the streaks of heads and tails.
Okay.
They then count the number of runs in the coin flip data and compare it to the number of runs in the actual stock market data.
And if the EMH is correct, the stock market runs should look almost identical to the coin flip runs.
And that is exactly what the empirical test confirmed. The actual number of runs and security prices fell squarely within the statistically expected limits of a purely random distribution.
Wow.
There were no meaningful predictable trends.
So the serial correlation tests and the run tests both validate the weak form. But the text also brings up filter tests. This feels more applied. This is testing actual trading strategies.
Yes. While the first 2 tests look at raw data, the filter test evaluates the actual mechanics of technical trading. It tests the profitability of mechanical rules. The most common is the X% filter rule.
Let's construct one. Let's say I write an algorithm that monitors a stock. If the stock hits a low point and then rallies upwards by exactly 5%, my algorithm assumes a breakout trend has begun, and it triggers a buy order.
Okay.
I hold the stock until it peaks and then drops by 5% from that high, at which point my algorithm triggers a sell order, assuming the trend has broken.
That is a classic momentum strategy.
Yeah.
You're trying to filter out the daily noise and only trade the substantial movements.
Right.
But researchers tested these exact rules across decades of market data. They ran the filter strategies, accounted for the transaction costs of constantly buying and selling, and compared the final returns against a simple, brainless buy and hold strategy where you just buy the index and go to sleep.
And the mechanical filter strategy loses.
It fails consistently. And it fails for the exact reason the EMH dictates.
Which is?
If the market is weak form efficient, the price movements between your 5% buy barrier and your 5% sell barrier are just a random walk.
Yeah.
You are essentially paying brokerage fees to trade statistical noise.
That makes total sense.
Meaningful price changes only occur when new information arrives to shift the intrinsic value.
So the weak form holds up against almost every statistical assault. But the text does introduce one fascinating behavioral caveat when discussing time horizons. It mentions the fad hypothesis.
The fad hypothesis.
This sounds like we are finally acknowledging human psychology.
We are. The fad hypothesis emerged when researchers noticed a divergence in the data depending on how far out you zoomed.
Okay.
They found that over very short horizons, a few days or weeks, there actually is a minor positive serial correlation. Momentum does briefly exist.
Wait, really?
Yes. But over long horizons, several years, there is a distinct negative serial correlation.
Okay, let's unpack the psychology of that for the exam. Positive in the short term means investors are overreacting. A company announces they beat earnings expectations by a penny.
Right.
The market gets hyped, retail investors see green on their screens, FOMO kicks in, and the price shoots up higher than the fundamentals justify for a few days. The trend feeds itself.
Exactly. It's a fad. But eventually, the math catches up.
The rational investors step in.
The rational investors and arbitrageurs look at the inflated price, look at the actual cash flows, and realize the stock has overshot its intrinsic value. So, over the long run, the price experiences a downward correction.
That is your negative serial correlation.
Precisely. Prices overshoot in the short run due to human hype, but correct in the long run due to mathematical gravity.
That is a deeply practical insight for anyone managing a portfolio. So the weak form is robustly validated by the data, even matching normal distribution curves associated with random events, like the Robert and Osborne study mentioned in the text.
Yes, the weak form holds strong.
Now let's escalate the difficulty. How do researchers test the semi-strong form? How do you mathematically prove that the market instantaneously digests and prices in public news, like an earnings report or a macroeconomic shift?
For the semi-strong form, researchers rely heavily on two methodologies. The first is building a mathematical baseline using residual analysis.
Residual analysis.
To understand if a piece of news caused an abnormal reaction, you first have to know what a normal reaction looks like.
Makes sense.
And to do that, the text utilizes William Sharpe's single index model.
Let's verbally map out this equation for the students, because it's a foundational concept. The equation is R sub I equals a sub I plus B sub I times R sub M plus E sub I.
Let's break it down variable by variable.
Okay.
The goal of the equation is to calculate R sub I, which is the expected return on a specific security.
Got it.
To find that, we start with a sub I, which is a constant. It represents the return of the stock when the overall market return is zero. It's the stock's independent baseline.
Okay, the baseline.
Then we add the core engine of the formula, B sub I multiplied by R sub M.
Right, so R sub M is the return of the overall market index, like the S&P 500. And B sub I is our sensitivity to that market.
Exactly.
So if the market goes up 10% and our B sub I is 1.5, this part of the equation contributes 15% to our expected return.
Exactly. You are calculating how the stock should behave based purely on how the broader market is behaving. And finally, you add E sub I, which is the random error term, accounting for the unpredictable noise.
So Sharpe's model spits out a number. It says, based on the market today, this stock should have returned 5%.
And that is where the residual analysis happens. You look at the stock's actual real-world return. If the formula expected 5%, but the stock actually returned 8%, you have a positive residual of 3%.
That 3% is an abnormal return.
Yes. The stock did something the baseline market math can't explain.
Okay, we have our baseline. We know how to spot abnormal returns. How do we use this to test if the market instantly digests public news?
This leads to the most famous methodology for testing the semi-strong form, the event study.
Event studies.
The text highlights a monumental piece of research by Forma, Fisher, and Jensen.
Oh, this study is fascinating.
It really is. They didn't have modern computers. They used punch cards to analyze roughly 900 stock splits on the New York Stock Exchange over a massive 3-decade period from 1927 to 1959.
Let's provide context on stock splits for the students. A stock split is purely cosmetic.
Completely.
If I own one share of a company worth $100 and the company does a 2-for-1 split, I now own 2 shares worth $50 each. My total value is exactly the same. The company's underlying fundamentals haven't changed.
Right.
However, companies usually only split their stock when the price has run up significantly, meaning a split is generally viewed by the public as a massive signal of management's confidence in future growth. It is highly anticipated public news.
So Fama, Fisher, and Jensen wanted to see how the market priced in this public signal of confidence. They used the residual analysis we just discussed to track the abnormal returns of these 900 companies in the months leading up to the split announcement, the day of the announcement, and the months following the split.
And if the market is semi-strong efficient, the price should instantly jump on the day of the announcement to reflect the positive signal, and then immediately return to normal, predictable behavior.
That's a theory.
Nobody reading the news the next day should be able to make an abnormal profit. What did the punch cards reveal?
The findings were a revelation. They observed that the stocks consistently earned significant positive abnormal returns in the months before the split was officially executed or even formally announced.
Wait, before? So the market was anticipating the positive fundamentals that led the board to consider a split in the first place, and it was aggressively pricing that positive reality into the stock long before the actual corporate event occurred.
Exactly. The supercomputer was connecting the dots of the public data rising sales, expanding margins, and driving the price up early.
Wow.
And crucially, after the split was formally completed, the abnormal returns vanished. The stocks immediately conformed back to the expected baseline market model.
So no lingering inefficiencies.
None. If you bought the stock the day after the split hit the newspaper, you earned exactly the normal market return. The public news was instantly and fully priced in.
That is an incredible validation. The market anticipated the event, priced it in, and then resumed its random walk, so the weak form holds up. The semi-strong form holds up beautifully in event studies.
It does.
Now we arrive at the final boss, testing the strong form.
The strong form.
The theory that the market magically prices in top-secret, heavily guarded insider information before it's ever made public. How do you possibly test what people are keeping secret?
Well, you can't measure the secret directly. Instead, you measure the performance of the people who hold the secrets.
Ah, clever.
You analyze the historical trading track records of corporate insiders, the CEOs, the board of directors, the chief financial officers. If the strong form is true, and the market perfectly prices in all private information instantly, then a CEO trading their own company's stock should not be able to consistently beat the market average.
Because the price already reflects the secret they know.
Exactly. The text points to empirical studies conducted by researchers Jaffa and Lorry. They dug into the mandatory filings where insiders have to report their trades.
And let me guess. The omniscient supercomputer theory finally hits a wall.
It crashes into the wall. And this is a vital exam point for the MBA student.
Write this down.
The studies by Jaffa and Lorry actively and definitively disprove the strong form of market efficiency.
They disprove it.
Their findings clearly demonstrate that corporate insiders consistently earn superior, risk-adjusted returns when trading their own company stock. They are able to leverage their monopolistic access to non-public information to buy before positive news breaks and sell before negative news hits.
So the secret does give them a measurable mathematical edge?
Yes. Furthermore, the studies extended beyond just corporate insiders. They looked at elite professional investment managers, the people running massive mutual funds.
And what did they find?
They found that a subset of these professionals, armed with vast research budgets, proprietary data networks, and deep industry connections, were also able to consistently outperform the market baseline over time.
So the strong form is a beautiful academic ideal, but the real world has friction. Information doesn't flow perfectly, secrets have value, the market is highly efficient, but it is not perfectly omniscient.
Which brings us to a massive pivot point in the theory and a critical transition for the student mapping out their exam strategy.
Okay, let's pivot.
Because we've now established a nuanced reality. The market is efficient enough that you can't beat it just by reading historical charts or public annual reports.
Right.
It automatically prices in almost all available public data.
Right.
So if you are an investor and you realize you cannot outsmart the market to generate alpha, what do?
You stop trying to find hidden gems and you start focusing entirely on managing your risk. If you are blindly accepting the market's pricing, you need a rigorous mathematical formula to tell you exactly how much return you should demand in exchange for the exact amount of risk you are taking on. If I buy a volatile tech stock, how much more return do I deserve compared to buying a safe utility stock?
And that precise question is what gave birth to Section 4 of your notes, the Capital Asset Pricing Model, universally known as APM.
CAPM is the heavy machinery of finance. The notes mention it was developed by William Sharpe, John Lintner, and Jan Mawson in the 1960s, building off the earlier portfolio work of Harry Markowitz.
Yes, the foundational work.
But before we get into the algebra, we have to define the fundamental variable they were trying to solve for. We have to define risk, Because in KPM, risk isn't just one big scary concept. It is divided into two very distinct categories.
This is a crucial distinction. Total risk, the overall volatility of an asset, is composed of two buckets. The first bucket is unsystematic risk.
Unsystematic.
This is the idiosyncratic, highly specific risk associated with one single company or one specific industry.
Give me an example of unsystematic risk.
Let's say you invest all of your money into a single airline company. Your unsystematic risk includes the possibility of their pilots going on strike, a flaw being discovered in the specific airplanes they fly, or their CEO being embroiled in a scandal.
Right.
Those events will crush the stock price of that specific airline, but they won't affect the broader stock market.
And the beauty of unsystematic risk is that you, as an investor, can eliminate it entirely for free. You just diversify.
Exactly.
If you take your money and buy a portfolio of 500 different companies across 50 different industries, one airline pilot strike is just a microscopic blip. The idiosyncratic failures are canceled out by idiosyncratic successes elsewhere in the portfolio.
Because unsystematic risk can be completely diversified away, the market absolutely will not compensate you for taking it.
Right.
You don't get a higher expected return just because you made the foolish decision to put all your eggs in one basket. Which brings us to the second bucket, the one CAPM actually cares about, systematic risk.
This is the risk you cannot escape, no matter how diversified you are.
Systematic risk is market risk. It is the macroeconomic gravity that pulls on every single asset in the ecosystem.
Like what?
It is a sudden spike in the federal interest rate. It is a global pandemic shutting down supply chains. It is soaring inflation. If the entire underlying economy contracts by 10%, your perfectly diversified portfolio of 500 stocks is still going to take a massive hit. You cannot diversify away systematic risk.
And because you are forced to endure this unavoidable market gravity, this is the specific risk that investors demand compensation for.
Yes.
The more exposed your asset is to the macroeconomic tide, the higher the return you require to hold it. And CAPM assigns a very famous Greek letter to measure this exact exposure.
Beta.
Beta.
The beta coefficient is the universal heartbeat of CAPM. It is the mathematical measure of systematic risk. It measures how intensely a specific stock reacts to the movements of the overall market.
Okay, so give me the math on that.
If the market goes up 1% and your stock consistently goes up 1.5%, your stock has a beta of 1.5. It is more volatile and more exposed to systematic risk than the market average.
Okay, so CAPM is built entirely on the premise of isolating and pricing beta. But to isolate a variable mathematically, academics have to build incredibly controlled environments.
They do.
The text outlines the 6 golden assumptions of CAPM. And if you are an MBA student, your professor is going to test you on these assumptions. Let's walk through the exact parameters of the CAPM sandbox.
The model requires extreme perfect conditions to function. Assumption 1, infinitely divisible units.
Meaning?
This means an investor can buy a fraction of a single share if the math dictates it.
Okay.
Assumption 2, investors are inherently risk-averse. If presented with 2 assets offering the same return, they will always choose the one with less risk.
Prudence.
Assumption 3, homogeneous expectations. This is the big one. It assumes every single investor in the market has the exact same information, uses the exact same models, and therefore estimates the means, variances, and covariances of all assets identically. Everyone agrees on the future.
Wow. Okay.
Assumption 4, zero transaction costs. Buying and selling securities is completely free. No brokerage fees, no slippage.
Nice.
Assumption 5, no personal income taxes. An investor doesn't care if their return comes from dividends or capital gains because it's all tax-free.
Even nicer.
And assumption 6, investors can freely lend or borrow an unlimited amount of money at the exact same riskless rate.
Okay, I have to stop the list right there because this is the moment in the lecture hall where the student throws their hands up.
I know.
No transaction costs, no taxes,
Yeah.
homogeneous expectations where everyone agrees on the future, and the most absurd one. I can go to JP Morgan right now and borrow $10 million at the exact same ultra-low interest rate the U.S. Treasury gets.
That sounds crazy.
It is a financial fantasy world. Why on earth are we studying a model built on parameters that do not exist in reality?
It is the most common critique of CAPM,
Yes.
and it is a valid one. But you have to understand the philosophical necessity of academic modeling.
Okay, explain.
When physicists try to calculate the theoretical effect of gravity on a falling object, the first thing they do is assume the object is falling in a frictionless vacuum. They eliminate air resistance, wind, and aerodynamics. Why? because those real-world frictions obscure the core mathematical relationship they're trying to isolate.
So FAPM is the frictionless vacuum.
Exactly. If Sharp and Lintner tried to build a model that included varying corporate tax rates, sliding scale brokerage commissions, and the fact that a retail investor pays 8% interest while a hedge fund pays 2%, the math would become a chaotic, unsolvable mess.
Right.
CAPM strips away the friction to reveal the pure, foundational relationship between systematic risk and expected return. Once you understand the baseline truth in the vacuum, modern analysts can manually add the real-world frictions back into the equation.
That makes perfect sense. You need the pure baseline before you can account for the messiness of reality.
Exactly.
So we have our frictionless vacuum, we have our definition of beta. Now we need to visualize the model. This brings us to section 5. Drawing the lines. CAPM is universally represented by two distinct upward-sloping lines on a graph.
The capital market line, the CML, and the security market line, the SML.
Let's construct the CML first.
The capital market line is the foundation of capital market theory. I want the listener to picture a standard graph.
Let's get picturing it.
The horizontal x-axis represents risk. But crucially, for the CML, the x-axis represents total risk, which we measure mathematically as standard deviation, or the Greek letter sigma.
Okay, standard deviation on the x.
And the vertical y-axis represents expected return.
Okay, x is total risk, y is return.
The CML is a straight line drawn on this graph. It anchors on the y-axis at a very specific point, the risk-free rate. Think of a short-term government treasury bill. Even if you take on absolutely zero risk, a standard deviation of 0 on the x-axis, you still get a positive baseline return just for locking up your money. From that risk-free anchor point, the line slopes upward.
And what does that upward line actually represent?
It represents the efficient frontier of all possible portfolios that perfectly combine that risk-free asset with the optimal, perfectly diversified market portfolio. Any point on that line gives you the absolute maximum possible return for that specific amount of total risk.
The text gives us the formula for calculating the slope of the CML, represented by lambda. The formula is lambda equals the expected return of the market minus the risk-free rate, all divided by the standard deviation of the market. Let's translate that algebra into intuition.
The numerator is the expected return of the overall market minus the risk-free rate. We call that the market risk premium.
The premium.
It is the extra percentage points the market demands as a reward for moving their money out of safe government bonds and into risky stocks.
Let's use real numbers to make it stick. If the market returns 10% and safe bonds return 2%, the premium is 8%. You demand 8% extra for taking the plunge.
Exactly. Then the denominator divides that 8% premium by the standard deviation of the market, the total risk. When you divide the premium by the risk, you get the slope.
And the slope is the exchange rate.
Yes. The slope tells you the exact exchange rate. It tells you exactly how much extra return you earn for every one single unit of total risk you add to your portfolio.
But hold on. We established earlier that the market does not compensate investors for total risk.
We did.
It only compensates them for systematic risk because unsystematic risk can be diversified away.
Yeah.
If the CML uses total risk on its x-axis, it's measuring the wrong thing.
And that is exactly why the CML is only the precursor to the final model. It is applicable for pricing perfectly diversified portfolios where unsystematic risk has already been eliminated, making total risk and systematic risk equal.
Okay, I see.
But if you want to price an individual, standalone stock like deciding whether to buy shares of Apple, the CML is useless. You need a line that isolates systematic risk. You need the security market line.
The SML. This is the beating heart of CAPM. How does the graph change?
The vertical y-axis remains exactly the same, expected return, but the horizontal x-axis undergoes a fundamental shift. We strip away standard deviation. The x-axis is now purely beta.
Beta.
It measures only the unavoidable macroeconomic systematic risk.
This is a guaranteed exam question. Circle it. Highlight it. The difference between the lines. CML uses standard deviation. SML uses beta.
Burn it into your memory. The SML plots the linear relationship between the expected return of an individual security and its specific beta, and the formula that defines this line is the most important equation in the chapter.
Give it to us.
It dictates that the expected return of a security equals the risk-free rate, plus the stock's beta, multiplied by the market risk premium.
Let's talk about the mechanics of this. The formula spits out a percentage. It acts as an absolute judge. Let's say I plug in the risk-free rate, the market premium, and the beta for a volatile tech stock, and the formula spits out 12%. CAPM is declaring that, based on the macroeconomic risk I am taking, I deserve exactly a 12% return. Anything less is unacceptable.
Yes. That 12% is your ex ante, or required expected return, but the real world is constantly trading. The stock is generating an actual expected yield in the live market based on its current price and projected cash flows.
Right.
The entire goal of portfolio management is to compare the CAPM formula's demanded return against the market's actual return to find mispriced assets.
Let's define the two states of mispricing: undervalued and overvalued. Let's start with undervalued.
An asset is undervalued if its actual expected return in the market is greater than the return demanded by the CAPM formula.
Let's use intuition here. The formula looks at the stock's beta and says, this is risky, you need to be paid 10% to hold this. But when you look at the stock's current beaten down price in the market, the actual yield you would get by buying it right now is 15%.
Right.
You are getting paid 15% for a bundle of risk that mathematically only requires 10%. You are getting a massive bargain.
Exactly. You are receiving excess return without taking on excess risk. Visually, on our graph, an undervalued stock plots physically above the security market line. Rational, risk-averse investors will rush to buy this asset.
And overvalued is the exact opposite.
Correct. If the actual market return is less than the CAPM required return, say the formula demands 10%, but the stock's price is so inflated that it's only yielding 6%, the asset is overvalued.
You're taking on risk for practically nothing.
You are not being adequately compensated for the systematic risk you are enduring. Visually, it plots below the SML. Rational investors will immediately sell or short this asset.
Okay, we need to ground this theory in reality. When you sit for your exam, you aren't just going to define the SML, you are going to have to calculate it.
Oh, absolutely.
We are going to walk through illustration 1 from the textbook right now. If you're listening, grab a pen. We are going to use logic to solve the math.
Walking through the mechanics is essential. Let's set the parameters for the problem. The textbook gives us 3 baseline data points for the broader market. First, the safe harbor. The risk-free rate is 5%.
Okay, risk-free is 5%. Got it.
Second, the overall expected return of the market portfolio is 16%.
Market return is 16%.
And third, the total risk, or standard deviation of the market, is 2.5%.
Okay, baseline established. Risk-free is 5, market return is 16, market standard deviation is 2.5. Now, the exam question asks us to evaluate a specific asset called Portfolio A.
Portfolio A.
Portfolio A is currently generating an actual return of 20% in the real world, and it carries a standard deviation of 3%. Our objective is to determine if Portfolio A is undervalued, overvalued, or perfectly priced. Walk us through the logic.
Our first step is completely ignoring the actual 20% return. We need to find out what Portfolio A should be returning based on its risk. We need to calculate its expected return using the capital market line formula the textbook utilizes for this specific problem structure.
Let's build the formula verbally. What's step 1?
We start with the baseline compensation. Even if Portfolio A had 0 risk, we demand the risk-free rate. That's 5%.
Right.
Next, we have to calculate the market's exchange rate for risk to slope. We take the market return, which is 16%, and subtract the risk-free rate, which is 5%. That gives us a market risk premium of 11%. The market pays an extra 11% for taking on risk.
Okay, so we have 11%. What's next?
We divide that 11% premium by the market's standard deviation, which is 2.5%, to find the premium per unit of risk. 11 divided by 2.5 is 4.4.
4.4.
The market pays you 4.4% for every single unit of standard deviation you endure.
Now we apply that exchange rate to the specific risk of Portfolio A.
Exactly. The problem states Portfolio A has a standard deviation of 3. So we multiply our 4.4 exchange rate by 3 units of risk. 4.4 times 3 is 13.2%. Portfolio A owes us 13.2% purely as compensation for its volatility.
And finally, we add that 13.2% risk premium back to our initial 5% risk-free baseline. 5 plus 13.2 equals an expected return of 18.2%.
The math has spoken. The theoretical model firmly declares that anyone holding Portfolio A requires an 18.2% return.
Now for the final judgment. The model demands 18.2%, but the prompt explicitly told us that in the real world, Portfolio A is generating an actual return of 20%.
Because the actual return of 20% is mathematically greater than the required expected return of 18.2%, the portfolio is generating excess yield for its level of risk.
Which means?
Therefore, it is undervalued.
That is how you break down the exam question. You find the required baseline, calculate the risk premium, multiply it by the asset-specific risk, sum it up, and compare it to reality. It's a bargain.
That's it, exactly.
Now, CAPM is elegant. It's foundational, but it has a glaring monolithic flaw that researchers eventually had to address. Which brings us to our final major topic, Section 6, Arbitrage Pricing Theory, or APT. Why did the academic world feel the need to invent another model? What is CAPM failing to capture?
Well, CAPM's greatest strength is also its greatest weakness, its simplicity. CAPM relies entirely on one single variable to measure all macroeconomic risk. It matches every single complex force in the global economy into one monolithic number.
Beta.
Beta represents everything.
Right. It measures how a stock moves relative to the overall market index, but the reality is the market is not a monolith.
It's a chaotic ecosystem of crosswinds. Exactly. A stock isn't just reacting to the S&P 500. It is simultaneously reacting to the inflation rate, shifts in the wholesale price index, fluctuations in the consumer price index, changes in central bank lending rates, and shifts in the GDP growth rate. CAPM completely ignores the nuance of these distinct forces.
It's too blunt.
Right. Stephen Ross recognized this flaw and developed arbitrage pricing theory in 1976. APT is explicitly designed as a multiple-factor model.
So instead of one massive beta to rule them all, we are decoupling the risk. We have multiple betas.
Precisely. Under APT, if a portfolio manager believes that a specific security is driven by 5 distinct macroeconomic factors, that security will be assigned 5 distinct beta values.
Interesting.
You will calculate one beta that measures the stock's specific sensitivity to inflation, another beta that measures its sensitivity to interest rate hikes, a third beta for GDP growth, and so on.
That sounds exponentially more complex to model than CAPM. But to anchor a multi-factor model like this, you need a fundamental philosophical bedrock. What is the core rule that makes APT function?
The absolute bedrock of APT is the law of one price. If you remember nothing else about APT for the exam, remember this law.
The law of one price.
It dictates an unbreakable rule. 2 distinct securities, or 2 portfolios that carry the exact same level of mathematical risk, must offer the exact same expected return.
Because if 2 identical bundles of risk have different price tags, you have a literal glitch in the matrix. You have an arbitrage opportunity.
And that ties everything back to our very first discussion about market efficiency. If the law of one price is violated, arbitrageurs instantly step in.
The scarp money returns.
They buy the underpriced bundle, short sell the overpriced bundle, lock in a riskless profit, and the sheer volume of their trades forces the prices back into identical alignment. APT is the mathematical blueprint of that arbitrage mechanism.
Before we look at the APT formula, are the assumptions in Ross's sandbox as extreme as KPM's frictionless vacuum?
They share some DNA, but APT is generally considered slightly less restrictive. The text outlines 6 basic assumptions for APT.
Let's run through them.
1. Perfect market conditions exist. So again, the frictionless vacuum.
Right.
2. The dominance principle applies. Given the choice, investors will always prefer more wealth to less wealth.
Shocking.
3. Markets are generally in a state of equilibrium, only briefly dislocated by new information.
Investors construct portfolios along the efficient frontier, seeking optimal risk-return trade-offs.
Okay.
5. Homogeneous beliefs. Investors agree on what the macroeconomic factors are and agree on the sensitivities to those factors.
Investors are universally risk-averse.
Okay, so we are still operating in a highly theoretical, academic space. Now, let's unpack the math. Expert, walk us through the APT return-generating model.
Sure.
The formula is a linear function representing a stochastic process. It looks like this. E equals A plus B sub 1 times F sub 1 plus B sub 2 times F sub 2 and so on plus E. Verbally break that down for us.
Let's demystify the variables. We are trying to solve for E, which is the total expected return on the asset. We begin with A. This is the baseline expected return of the stock. If every single macroeconomic risk factor we track had a value of exactly 0, it's the absolute starting line.
Then we start adding the distinct risk premiums. Let's look at the first pair in the sequence, B sub 1 times F sub 1.
F sub 1 represents the actual numeric value of the first macroeconomic risk factor. Let's say factor 1 is the inflation rate, and inflation is currently running at 3%, so F sub 1 is 3.
Got it.
B sub 1 is the stock's specific sensitivity, its unique beta to inflation. If this stock is highly vulnerable to inflation, its B sub 1 might be 1.5. You multiply the factor 3% by the sensitivity 1.5 to find out how much return the stock demands to compensate for inflation risk.
And then you just repeat that process. You multiply the interest rate factor by the interest rate beta. You multiply the GDP factor by the GDP beta. You do that for F sub 2, F sub 3, all the way to n number of factors, and you add all those specific risk premiums together.
Exactly. You're building a custom-tailored suit of risk compensation, and finally the formula ends with plus E.
The random error.
Yes, E is the stochastic random error term. It accounts for the unsystematic, company-specific surprises, the CEO resigning, the factory burning down. APT acknowledges this noise exists, but it mathematically assumes that over a sufficiently large and diversified portfolio, the positive surprises and negative surprises average out to zero. So the mean value of E is zero, and it drops out of the macro equation.
The beauty of this multi-factor approach is the control it gives a portfolio manager. Under CAPM, you just have to accept whatever beta the stock has.
Right.
Under APT, a manager can say, I believe inflation is going to surge, but I think interest rates will remain flat. They can then use the APT math to hunt for a portfolio of stocks that have a very high sensitivity to inflation, but a zero sensitivity to interest rates. It allows for surgical precision in risk exposure.
It does. But theory is only as good as its application. Which brings us to the climax of the chapter, arbitrage in action. How do we use the APT equation to actually spot a mispriced asset and execute a trade?
Let's do our final audio math walkthrough. We are using illustration 2 from the textbook.
Okay, in this scenario, we have a market that is driven by two specific macroeconomic factors. A quantitative analyst has calculated the baseline APT equation for this market. The equation is expected return equals 3 plus 2 times B sub 1 plus 3 times B sub 2.
Let's interpret that equation. The constant baseline A is 3%. The premium awarded for being exposed to factor 1 is 2%, and the premium awarded for being exposed to factor 2 is 3%.
Correct. Now, the analyst targets a specific asset called Portfolio P. The actual expected return of Portfolio P, trading live in the market right now, is yielding 9%.
9% actual yield.
The analyst has calculated Portfolio P's specific sensitivities. Its sensitivity to factor 1, its B sub 1 is 0.75. Its sensitivity to factor 2, its B sub 2 is an even 1.
Our objective is to determine if the law of one price is holding true or if an arbitrage opportunity exists. We need to plug Portfolio P's sensitivities into the market equation to find its fair value. Walk us through it.
We take the market equation, 3 plus 2 times B sub 1 plus 3 times B sub 2. We substitute our specific betas, 3 plus 2 times 0.75 plus 3 times 1.
Let's do the math.
We do the multiplication first. 2 times 0.75 is 1.5. Next, 3 times 1 is 3. Now we sum up the baseline and the two premiums, 3 plus 1.5 plus 3.
3 plus 1.5 is 4.5. 4.5 plus 3 is 7.5. The APT formula dictates that based on the precise multi-factor risk profile of Portfolio P, it should yield exactly 7.5%.
That is a mathematically fair value. But the prompt stated that Portfolio P is currently yielding 9% in the real-world market.
Just like in CAPM, the actual yield of 9% is greater than the required yield of 7.5%. Portfolio P is offering excess return. It is undervalued. The law of one price is currently broken.
And this is the moment the machine activates. How does the market correct this violation?
The arbitrageurs see the math. They see a portfolio paying 9% when it should only pay 7.5%. It is essentially free money. They immediately execute massive buy orders for Portfolio P. What happens to the price of an asset when billionaires start buying it aggressively? The current trading price skyrockets.
And this is the crucial mechanical inverse you must understand for the exam. As the current upfront purchase price of the security is driven higher by the buying frenzy, the percentage yield of its future cash flows automatically gets compressed. It goes down.
It's a seesaw.
Exactly. The algorithmic buying will ruthlessly continue, pushing the upfront price higher and higher, squeezing the percentage yield lower and lower, until that actual 9% yield is crushed exactly down to the mathematical 7.5% required rate.
Equilibrium is restored. The glitch in the matrix is patched. And if the situation were reversed, if a portfolio mathematically required a 10% return but was only yielding 8% in the market, it would be overvalued.
Yes.
The arbitrageurs would mercilessly short sell it. The massive selling pressure would tank the current stock price, which ironically increases the future percentage yield, driving it back up to the required 10%.
That is the relentless mechanical engine of global finance. It is constantly recalculating these multi-factor equations, identifying microfractions of mispricing, and executing blunt force arbitrage to enforce efficiency.
Which perfectly brings us full circle to the very beginning of this deep dive. We started by exploring the Harshad Mehta scam and asking what actually makes a market efficient. We discovered that the ultimate enforcer of efficiency is the third pillar, effective arbitrage, correcting irrational deviation.
Exactly.
Arbitrage pricing theory is simply the mathematical blueprint of that exact policing mechanism.
It is the ultimate synthesis of the material. For the MBA student preparing for this exam, your ability to articulate how these three major theories stack on top of each other, how they inform each other's flaws, is what will elevate your answer from a B to an A.
Let's do a final rapid-fire recap to synthesize everything we've covered today. Think of this as the final blueprint before you walk into the exam room.
Good idea.
We started with the environment. EMH, the efficient market hypothesis. EMH defines how the market supercomputer absorbs information. The weak form proves that historical price data is already absorbed, rendering technical analysis useless. The semi-strong form proves that all public data is instantly priced in, neutralizing fundamental analysis.
And the strong form theorizes that even private secrets are priced in, though empirical evidence regarding insider trading proves reality is far messier.
Once we establish that investors largely cannot outsmart the efficiency of the market, we move to CPM, the capital asset pricing model. CPM provides the foundational mathematical metric to demand compensation for blindly accepting market risk.
Right, it isolates systematic risk, the macroeconomic gravity, and measures it using a single factor, beta. We walk through the capital market line, which uses standard deviation to price total risk, and the security market line, which uses beta to price systematic risk. We demonstrated how to find undervalued assets by comparing actual market returns against the CAPM baseline.
And finally, we addressed EPM's monolithic flaw by introducing APT, arbitrage pricing theory. We established that real-world risk is driven by multiple crosswinds: inflation, interest rates, GDP. APT decouples the risk, assigning a unique beta to each macroeconomic factor.
Anchored by the law of one price, APT maps out the exact mathematics that arbitrageurs use to instantly identify mispriced assets, executing trades that literally force the market back into a state of efficiency.
If you can intuitively explain how EMH sets the environmental rules, how APM establishes the baseline pricing of risk within those rules, and how ATT expands that pricing into a multivariable reality enforced by arbitrage, you possess a master-level understanding of Chapter 13.
You really do.
But before we officially sign off, we always like to leave you with a final provocative thought, something that isn't explicitly in the textbook, but builds on the foundation we just laid and forces you to question the future of the material you are studying. Expert, what is the final thought for today?
Well, if we look at arbitrage pricing theory, its entire premise relies on participants instantly spotting mispriced assets and executing massive trades to correct the market. Historically, this relied on human analysts, human brokers, and the physical limits of human cognition. But look at the reality of Wall Street today. We no longer have guys in suits yelling on a trading floor. We have algorithmic supercomputers, fueled by artificial intelligence, co-located mere feet from the exchange servers. They're executing complex, multi-factor APT arbitrage corrections in fractions of a millisecond, reacting to global data feeds instantaneously without any human intervention.
It's all machines now.
It is. This raises a profound question about the evolution of the efficient market hypothesis. Does the lightning speed and cold mathematical logic of modern, machine-driven arbitrage effectively push our real-world market significantly closer to the theoretical, strong form of efficiency? Or, by completely removing human rationality from the immediate execution and relying purely on cascading lines of code, does it just create entirely new, deeply unpredictable types of systemic random errors? Are we perfecting the machine, or are we just building a machine that can crash the market 1,000,000 times faster than Harshad Mehta ever could?
That is a phenomenal, slightly terrifying question. When the supercomputer is both the analyst and the arbitrager who is policing the supercomputer, that is something to actively mull over as you close your books tonight.
Definitely something to think about.
To the MBA student listening, we know this material is incredibly dense, but you now understand the mechanics beneath the math. You know how the engine works. We warmly wish you the absolute best of luck on your portfolio management exam. Take a deep breath, trust your understanding of the logic, remember the difference between standard deviation and beta, and review these core concepts one last time before test day. You have the tools, now go crush it.